Ladies and gentlemen, good day and welcome to the Repco Home Finance Limited Q4 FY22 earnings conference call hosted by Yes Securities. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rajiv Mehta from Yes Securities. Thank you, and over to you, Mr. Mehta.
Yeah, thank you, Faizan. Hi, good afternoon, everyone. Thank you for joining in this call, and thank you to Repco's management for giving us this opportunity to hold the Q4 FY22 earnings call. So from the management side, we have got Mr. K. Swaminathan, MD and CEO, and other senior management team members. So now, without further ado, I would request Mr. Swaminathan to give his opening remarks, post which we can take questions. So over to you, Swaminathan, sir.
Good evening, everybody. I am Swaminathan, MD and CEO of Repco Home Finance. Thank you, Rajiv. Thank you, moderator. I have with me my entire management team, my both full-time directors, my CFO, and as well as the entire general manager's team, along with Mr. Bala, the representative, connected with the connection today. Welcome to the earnings conference call for the 3 months and the year ended March 31, 2022. This is my first time meeting you all in my new role as CEO and Managing Director of Repco Home. On behalf of the company, I extend a warm welcome to all of you and thank you for joining us in the call today. First of all, I'm thankful to the quarter that has gone by was first in the last 5 or 6 quarters that don't have any issues related to COVID. We hope that things are moving forward. Some positive things, the board has approved the FY22 financials on Monday and has also approved a dividend payment of rupees 2.50 per equity, that is 25% for every share of 10 rupees. I should tell you that the business activity has indeed picked up in Q4. With sequentially, both the loan sanctions and disbursements have recorded handsome growth. Loan sanctions increased 31% in the calculated quarter of March 2022 to about 652 crores from about 498 crores in Q3. Same way, disbursements have also increased 35% Q on Q to about 601 crores as compared to about 444 crores in Q3. The issue is the loan book has not moved mainly because of huge repayments and prepayments. The annualized repayment ratio, including regular repayments, stood at 21% in Q4. We lost 466 crores worth of loans to prepayments alone during the quarter. The prepayment was just 248 crores in Q4 of 2020-21. The repayment ratio for the entire financial year also remained elevated at 17.6% as against 13.1% in FY21. On the profitability front, we have reported strong loan spreads and margins at 3.9% and 5%, significantly above our guided levels of 3% and 4.3% respectively. And I expect the spreads and margins to remain higher than our guided band even in FY23. The profit before provision line, that is before provision, before taxes, has risen by about 5% year on year to about 493 crores in FY22 as against 470 crores in the previous year. This is despite there is a reduction in the loan book. Hence, profitability has not declined. On the contrary, there is a marginal increase. The GNPA has declined 2 basis points to 6.97% sequentially. However, the NPA has fallen by 13 basis points and now stands at 4.86%. GNPA provision coverage registered a 2% sequential improvement, 32%. And the overall ECL provisions has increased 0.5% sequentially to 4% of the loan book. That said, I will be focusing on reducing NNPA gradually. We earned the ROE of 1.6% and ROE of 9.6%, though it may have fallen from the previous year. This mainly because of the provisions made. The credit cost, that is ECL provisions, were at 233 crores in FY22 as against a mere 81 crores in FY21. The balance between our exposure to self-employed and salary segment stood at 51.2% and 48.8% respectively. Similarly, the share of non-housing loans, that is LAP, is about 19.1% of the loan book. The total capital adequacy ratio is very comfortable at 33.6%, of which Tier 1 alone is 33%. Our branch network is around 155 branches and 24 satellite centers. We would be resuming our network expansion in FY23, maybe after the second quarter. We have a strong liquidity to remain comfortable. We have carried around 600 crores of cash and cash equivalents at the end of March 22. In addition, we have around 1,900 crores of unutilized lines of credit from banks. So our liquidity coverage ratio is comfortable at 238%, versus the regulatory requirement of 50%. We plan to start, because there is a negative carry because of deposits and all, so we plan to start making investments at least in a smaller way in better yielding government securities. For the future, I expect the company to come back to the growth path in FY23 with a loan growth book of around 10%. In addition, I hope that the NPAs also will gradually come down from the second half of FY23. The NPA ratio may come down around 60 to 120 points from the present level. I will summarize the key financials. The pre-provision operating ratio has increased 5% to about 493 crores. The higher credit cost has alone led to a PAT decline of about 33% to about 192 crores. The loan book is at 11,759 crores. The ROA and the ROE are at 1.6% and 9.6% respectively. Core profitability has remained strong. NPA stood at 6.97% with a coverage ratio of 32%. Sequentially, there has been a growth in NIM, there has been a growth in profit before tax and the provision. I think this all as of now. I will be very, very happy to answer all your questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The first question is from the line of Akash Jain from Money Curves. Please go ahead.
Yeah, my question is just to understand what is happening on the GNPA. If I look at the results of all companies in financial services, including all the housing finance companies that have come out with results, all have shown a significant decline in GNPA numbers, and probably we are the only financial services company or HFC who has not done the same. So it's quite surprising as an investor that while everyone has shown a marked decline in provisions and non-performing assets, we have been stuck with the same levels as last quarter. So can you please help us understand what really is happening and why are we not able to bring that ratio down? Thank you.
See, it's mainly because of Q3. Q3 numbers, I think you may be knowing, it's mainly because of the November 21 circular of Reserve Bank of India. The circular did not have any differentiation as far as identification of an NPA account. Okay, so any account which became 90 days NPA overdue was NPA even prior to the circular. Only issue was, see, we were upgrading an account if the overdue as at the end of a particular month or particular quarter was less than 90 days. That particular thing has now been removed. As a result, our GNPA numbers has risen in Q3. But as far as Q4 is concerned, I would like to inform, there is nothing significantly that is changed. See, our additions or the slippages in Q4 has remained the same, or in fact it is better than even Q3 and the Q1. Just to give you the numbers, in Q1 we slipped around 95 crores. Q3, other than RBI circular, because of RBI circular, 277 crores was our slippage. Even without that, our slippage was around 113 crores. Whereas in Q4, we were able to contain the slippages to around 90 crores. Similarly, in Q4, we have been able to recover around 96 crores. As a result, the GNPA numbers has remained constant or slightly come down. I do not know about the other companies. And we decided not to move back. Whatever the RBI thing that we have already implemented, we decided to continue. We did not move back to the pre-RBI provision. Even though RBI permitted us to do that, we did not do that. So
we have created a lot of provision.
As far as NPA is concerned, yes, NPA is at the peak as of now, but gradually it will decline from the second quarter onwards.
So I understand this problem of the RBI regulation and the fact that we have to, according to the new norms, our number will look elevated. I am more worried about the provision that we are creating every quarter, right? Last quarter, because of the increased RBI norms, I think we had to make an extra provision because of the new norms. But this quarter, again, we have made a very significant provision and write-off. So I just want to understand, GNPA number by itself is not a worry, but provisions every quarter is a big worry, right?
See, we have not done any write-off. Let me be very clear. We have not done any write-off this quarter. As far as provisions are concerned, I think it is better, it will be strengthen the company's balance sheet if we make increasing provision, incremental provision for the same stock. I am not adding provision for a new NPA. I am adding provision for my existing stock. I think over a period, this will only strengthen my balance sheet. See, as of now, we have 32% coverage for my stage 3. Over a period, we want to increase it, not significantly, but at least gradually over a period, so that by end of 2023, we reach at least 50%. My idea is we need to grow, we need to increase our profits, as well as simultaneously, we also need to increase our provisions so that we are comfortable on both sides.
See, I have been an investor in this company for almost 7-8 years now. Okay, so if we look at our own history of credit losses over the last 10-15 years, we have had very low credit losses. So I am really surprised that we want to take up the provision coverage rate to 50%, given that in a housing finance company and given our own track record of collections, we have hardly had any credit losses. So what is the reason that we are aggressively provisioning and trying to get the coverage ratios to 50% when our history has been fairly benign in terms of final write-offs and credit losses? Is there something much worse this time in the book than we have had over the last 20 years of our history?
Sir, let me make it very clear, we are not doing any aggressive provisioning. See, whatever provisions that are required, as per the rule, that is the same thing we are doing, except some 10 or 15 crores, that's all. So there is no aggressive provisioning as of now. But I just want to give you information that we are supposed to move to the IRAC provisions also over a period. What is the date? I think over a period, our provisions as per India should be more or less equal to the IRAC provisions of RBI. As of now, we are quite comfortable. But going forward, I do not want to create a shock in one quarter we make huge provisions. So it is better that we make a gradual increase in provisions so that even on a later date, when we are if at all we are meeting IRAC requirements, we will be quite comfortable. Today, my provisions under India is around 100 crores more than what would have been an IRAC provision. But going forward, since these assets which have been classified in the third quarter will move to the D1, D2 category as per IRAC now, those days there may be a requirement of higher provisions as per RBI now. During those periods, I do not want to be found wanting. So I think prudentially it is better that I increase my provision gradually along with my increase in profits so that I am not found wanting on a later stage, say 4 quarters hence or 5 quarters hence. I think you will appreciate my plan.
So if the slippages remain the way they have been over the last 3-4 quarters, and we all assume that we will not be hit by more COVID issues, how long do you see such elevated provisions and impact on profitability of the company? For how long should investors expect profitability to remain low because of increased provisions?
Sir, I understand your concern. Let me make it very clear, profitability will not become low because of provisions. My idea is let us increase profitability as well as this. See, the idea is we need to increase our growth, not a stagnant way of business numbers so that the profitability remains stagnant and we increase our provisions. That is not my idea. My idea is we should increase our profits by better businesses so that the profits are also more, the provisions also gradually and sequentially improve so that the profits also remain elevated. Definitely, there will not be any accelerated provision at the cost of profit.
Okay, thank you.
Thank you. The next question is from the line of Aviral Jain from Singular Guff and Company. Please go ahead.
Yeah, thank you so much, sir. Sir, welcome aboard, first of all. I wanted to ask you about 3-4 issues. One is, if you could just outline your 3 to 5 year strategic plan for the company, if you have something that you've presented to the board or have something in mind, given that you're in the system for almost 2 months now, in terms of loan book growth, the segments. Hello?
I'm sorry for interrupting. The voice is not clear. Can you be a bit more audible?
Yeah. Am I audible now?
Yeah.
Yeah, my request was if you can outline your 3 to 5 year business plan of what you would want to achieve now that you've come on board for the next 2 months, in terms of loan book growth rate, any segments that you are missing out on, and how would you accelerate, you said, growth and profitability. So would you look at more LAP or increase geographically? One more thing that you mentioned was the repayment rates have been very high because competition is very active. And this is something that I posed to the previous management as well, that there are number of HFCs which do a higher yield, and there could be very right borrowers, very creditworthy borrowers for us to choose from for us, as in somebody is taking your good profile borrowers, you can also take somebody else's good profile borrowers who are at much higher yield. So more strategic questions, and then I have a couple of questions there on current finances.
See, the plan is, we have presented to our board in April what is our growth plan for the current year. We want to grow. I do not want to make tall promises. We want to grow around 10 to 11%. We want our loan book to be around 13,000 crores by the end 2023, March 2023. We want to grow 10 to 11% to around 13,000 crores. This is the broad outline as far as thing is concerned. The NPA we want to contain and we want to bring down at least by 100 to 150 crores. We have a challenge of restructure loans that is coming up in the second quarter. So taking that into account, we have made a borrow rate NPA reduction of around 100 crores as far as NPAs are concerned. And along with the growth, we also want to create a proper atmosphere, proper systems and controls, so that we move gradually and we move systematically, and so that there are no issues down the line. These are all the broad areas which have been presented to the board also. And I understand your concern. Yes, we have some 1 or 2 issues facing the company. That is, one is related to asset quality. One is because of the RBI circular. We are addressing it. And one is by constant interactions. We have a big team. And we want to increase the team also, so that we want to have some 40-50 people exclusively for collection. So that not only NPAs, the likely NPAs are also brought down. That is a broad thing. Not only that, we have to educate our borrowers. See, these borrowers have been rather over the years, they have been asked to pay only the limited sum of the EMI. So the overdue borrower used to pay only the EMI, one EMI or something. Whereas his overdues are 2 or 3 installments. So slowly and gradually we are educating the borrower so that he starts paying more. This is one thing. And as I said, we will also have an exclusive collection line. So this way we want to address asset quality. The other concern, as you rightly pointed out, is regarding takeovers. So whatever growth we are making, I should say that even in the current quarter, we have made substantial sanctions as well as disbursements. In fact, 45 days, we have made enough disbursements that are equal to the entire quarter of the last 2 years. Whatever was done in the whole quarter, we have done already in 45 days. But this takeover is remaining a concern because of it, our book is not growing. That is a problem. Yes, we are addressing it. We have asked our field people to meet all the existing customers to understand their concerns so that these takeovers are limited, minimized. That is one issue. And wherever reduction in interest rates are sought for by the customers, yes, we are addressing. We are agreeing to it so long as it doesn't go below our MNR and we are not out of pocket. Third one is we are planning to introduce civil-related products so that a person is a better civil score or who has improved their civil score after coming to us, we are able to fund him more so that his temptation to go to another organization is limited. All these things we are addressing. Hopefully, it is gradually decreasing. I should say in the last quarter, our takeovers were around 460 crores or something. It is coming down gradually. In the current month, it is only around 60-70 crores. I do not have the exact number, but very less. So gradually things are coming down. I think I will be able to address, the management will be able to address if they take over as well.
And from a system readiness perspective, I know the previous management was working on overhauling the loan management system from an IT perspective. How is that moving along? Are you satisfied? Is there substantial changes need to be made for you to implement your strategic plan?
The IT system is already, the change is already under implementation. Hopefully by September, our new system will be in place. Our new LMS system will be in place. Along with this, the peripherals are also being implemented. The other related systems like HR, risk, all these things are also getting implemented. So hopefully by September quarter, the new system will be in place.
If I were to do a apples to apples comparison, as in if we ignore the RBI circular, how are the loan buckets behaving? As in compared to last year, the same time, say March 21, how much is your 90 plus? How much is your 60 to 90 and 0 to 30? If you can just give some broad breakup of the book, so that this.
I understand the question. I don't have the exact numbers, but broadly I think it has come down slightly. The bucket 2 has come down. It was around 1,000 crores or something. It has come down. It is coming down gradually, and we are addressing it vigorously.
Yeah. Any broad numbers you can give? 90 plus, it was 4.1%. I guess last March. How much it is?
I'll have to give you post the content.
Sure. Okay. And anything about the segment that you are missing out on, or the current underwriting policy is good enough for you to? I mean, what's holding back this growth? If I may ask that.
Can you please repeat the segment? Your question?
I'm saying, what is it that is holding back the growth? A lot of NPAs and other things are also because the loan book is not growing. So I just wanted to understand as to what is it that are you not targeting a particular profile of customers, or there are very strict underwriting norms which has led to this lack of growth other than the takeover issue?
See, it's not specific. Maybe I do not want to go into the past. Maybe we were targeting more high-class customers with a very good civil score and all that. And there the competition is too huge, and we are competing with the giants with a lower cost. Maybe that was one of the reasons why our loan book was not growing. Now we are more practical. We know where we are. Of course, along with the quality, along with the numbers, we are also seeing the quality. Hopefully things will change. In fact, things are changing. I should say things are changing. The entire field, I have visited the branches and visited the regions also. Everybody is going to go. Hopefully things will change in the current year.
Thank you. Mr. Jain, may we request that you return to the question queue for follow-up questions. The next question is from the line of Sanket Chheda from B&K Securities. Please go ahead.
Yeah, hi sir. We understand this quarter's provision, as you said, maybe was to strengthen the balance sheet. But what credit costs we expect in FY23? That's one. And we said that we would see asset quality improvement starting Q2. So from the current stage and the restructure, do we expect
any audio is not clear from your line.
Is it clear now?
Yes, sir. Please go ahead.
Yeah, now it's clear.
Yeah. So the first question was what will be the FY23 credit cost guidance for you? And secondly, you mentioned that you would see security improvement starting Q2. So will there be any further gradualities as you structured all stage 2 in first quarter that you expect?
Sorry to interrupt you, Mr. Chheda. The audio is breaking from your line, sir. Please check.
Okay, it's okay. I think he is more asking more about the asset quality. See, we have planned to bring down the NPAs from around 800 crores as of now to around 700 crores by March 2023. That is the thing. See, there is nothing significant as far as the slippages are concerned. Only one issue that what we informed is related to the restricted portfolio of around 600 crores. I think that we had already given in the previous Concall. Those accounts are falling due for payments in the second quarter onwards. As of now, there is no worry. Let me be very clear. As of now, there is no worry. As of now, things are doing well. Around 200, 300 crores already they have repaid. They are all in line. But going forward, there may be some small slippages from this particular portfolio. So anticipating that only, we have given a moderate reduction in NPA, only by around 100 crores, even though we could have projected more.
Okay, and what would be the credit cost for FY23? Any ballpark number that you can guide?
Around 80 to 100 crores.
Okay, sir. And sir, any change in strategy on the building increment? We have been despite disbursements coming back to pre-COVID levels. So how do we plan to book in FY23, and do we have any growth number per se which we will work on?
Okay, the voice is not clear.
Mr. Chheda, the audio is breaking from your line, so request you to please rejoin the question queue. Thank you. We'll move on to the next question from the line of Darshan Deora from Invest Capital. Please go ahead.
Thank you for the opportunity. I had a question regarding the slippage, regarding the provisions of 61 crores. So in the commentary, you guys mentioned that in Q4, the slippages as well as the recoveries were almost at par, right? I think you mentioned a figure of, 90 crores and 86 crores. So this provisions of 61 crores, where is this, where is this number reflecting in your, in that GNP NPA slide in your presentation?
This is the operator, sir. We are not able to hear you.
Yeah. See, in stage 3, the actual provisions are around 16 crores, 60 crores. In stage 3, around 15 crores. In stage 2, for restructured also, we have increased our provision. So the 60 crores has gone between the stage 2 and stage 3.
Okay, so about 15 crores in stage 3 and about 45 crores then in stage 2, essentially. Okay. Thank you. That's all from my side.
Thank you. The next question is from the line of Rishikesh Oja from Robo Capital. Please go ahead.
Hi, sir. So my question on the earlier in the last quarter we had added provisions and as per the RBI circular and so just wanted to know, we've taken a lot of provisions in this quarter. I wanted to know whether it's more of a
Sorry to interrupt you, Mr. Oja. The audio is breaking from your line, sir.
Hello.
Yes, sir. Please go ahead.
Okay, so my question is for us, and we have picked out.
Sorry to interrupt you again, sir. Mr. Oja, the audio is breaking from your line, sir. We are not able to hear your audio clearly.
Am I audible now?
Now you're audible, sir. Thank you.
Okay. I was asking if the NPA issue is it structural now or have the NPAs peaked out?
Sir, I can say the NPA is peaked out. NPA is peaked because in third quarter itself. But there will be normal slippages. I think you should understand there will be a normal slippages for any organization of ours, like ours. So there is nothing special. Even the NPA peak that was there in third quarter was not because of any new asset concern. It is only because of the implementation of the new guidelines from RBI. As of now, as it was, there was no concern as far as asset quality is concerned. It is still in the same mode. Only thing is because of the RBI circular, we have to declare higher NPA.
Okay. And if I heard correctly, you said for FY23, you said credit cost of around 80 to 100 crores, right?
Yeah.
So that would mean that from the next somewhere in H2 of FY23, we should be back to our normal profit, right, of 80 to 100 crores.
Should be, sir. I am just being conservative. I am feeling that by end of 2023, we will be better off. But as I see, maybe by second quarter itself, we will be able to cover entire thing. But I don't want to give a false number, so better to take it as fourth quarter.
Okay. And sir, if you could comment on what is the branch expansion plan?
Yeah. So this quarter, there may not be much, one or two only. But for the second quarter onwards, yes, we already have some certain branches which have been approved by our board. And we will be adding another 5 or 10 maybe by the year end. So it will be gradual for the whole year, it will be gradual.
Oh, okay. So that's all. Thank you.
Thank you. The next question is from the line of M. Agarwala from Phillip Capital. Please go ahead.
Yeah, sir, I have a couple of questions. One is, can you quantify your stage 3 asset and the provision on stage 3?
Yeah. 820 crores, 261 is the provision.
Sorry, sir, I missed that number. Can you repeat for me?
820 crores. Stage 3.
Okay.
Provision is 261 crores as of now.
261. And sir, sorry to be repetitive, but it will be very helpful for all the investors present in the call if you can provide us a milestone which you want to achieve in terms of growth in next 1 year, 2 years. That's one part. And second part, if you can be more elaborative in terms of how do you want to restrict the prepayment which is very high in your organization. These are the two parts. If you can clarify, that will be very helpful.
See, as I told, this year I'm more conservative, so I'm making a growth expectation of only around 10 to 11%. So from around 11,900 or 12,000 crores, we want to move to a maximum of 13,000 crores by March 23. Maybe 23, 24, and 24, 25, we would be accelerating. As far as this is the broad numbers as far as growth is concerned. Addressing the Repco issue that you were talking about, yes, I told, I will repeat. One, we have asked, see, the customers are not being met. Unlike other financial institutions, the customers here are one-off transactions. They come, they avail a loan, and they are making payments through ECS and all that. So the customers are not being met. So possibly these customers are moved or by other institutions who are also in the same field by interest rate and all that. So the first instruction that I have given to our field is, please meet all the existing customers. Maybe he may be 10 years old customer or 5-year-old customer. It will be met. Should concerns be heard. Wherever it could be redressed, let us redress. Possibly he may come up with requests like interest rate. He may come up with requests like top-up loans and all that. So we are addressing this issue. We are developing a product that is CIBIL-based top-up loans which could be given for the same customer. If his CIBIL score has increased, what is happening is the customer, when he enters our company, his CIBIL score may not be good. Maybe let us say it is around 500 or 600. Maybe because of his prompt repayment in our company, his CIBIL score improves to from 50 or 795. Based on this, he is being censored by other institutions. The two with a cost advantage compared to us. So these organizations try to take over. This is where we are losing. This is what we found. So we are trying whether we can devise our own product so that these customers can be met by ourselves instead of being going to other companies. This is one way we are doing. Third is wherever reduction in interest rate is possible, wherever within our system, if it meets our MLR requirements and all that, wherever it's feasible, we are agreeing for interest rate reduction for our existing customers with a good track record. In fact, as of now, we do not have any pending request for interest rate reduction. All interest rate reductions running to hundreds of account numbers we have already permitted. Maybe there may be a slight decrease in the income, but at least it will prevent takeover.
So, do you expect your margins or spreads to see some moderation as we go along?
That can be met by our volume growth, sir. Yes, there could be for the same book. If I am going on decreasing my interest rate, there could be challenges. But by increasing my volume, I think I will be able to meet and maintain the existing margins.
And the final question, sir, do you plan to move to low ticket size loan book?
Okay. See, the having a low ticket, we need to be there in the market. See, you can't have a flat at 15 lakhs. As of now, our low ticket size is 14.5 lakhs or something. You will agree that at this thing, you will not find a flat in places where we operate. So we need to be practical, and there will be some increase in our ticket size, which will be in line with the market requirement.
Sure, sir. Thank you. Thanks for answering my questions.
Thank you. Next question is from the line of Aviral Jain from Segler Graph and Company. Please go ahead.
Yes, just a second. My other question was around any plans to get into asset pool buyouts of other housing finance companies through securitization transactions. I mean, some of the lesser funded HFCs would have some funding constraints, and given Repco has very strong capital adequacy and low cost of funds, is that an area that is also being explored?
Yes, sir. Let me admit, but it is not immediate, but it is in the horizon. Creating our own sectors like approval of policies and all that. If the opportunity presents and if it is positive to us, we will take a look.
And what would be the amount of, as in the size of the market that you could be targeting, as in there would be a certain 10.5%, 11% sort of sourcing, as in acquisition yield you would be probably looking at similar to the current loan pool you have, or you would be looking at a lesser sort of yield on that portfolio given it would not require any servicing. And so my question is twofold, as in what would be the characteristics of such loan pools and what is the addressable market that you could look at available at that cutoff yield for you?
See, I think it's too early. We are still not devised our full strategy for that. But definitely it will be more or less in the same bracket that we operate. It will be in the same bracket we operate. But let me be frank, we are ready to finalize all the details.
Okay. Sure. And I think you've already given a clarification twice on the GNPA, but I was just curious to understand if you plan to bring down the GNPAs by 100 and 150 odd crores, then the provisions required next year could be way much lesser than 80 odd crores. Assuming you were to, as if your desire would be to have 50% coverage, specific provisions, because you would always have general provisions as well, right?
Okay, I think you know better about things. We will work out that. Definitely, if we don't require, definitely we will not be making that provision. The idea is to reach a provision coverage ratio of stage 3 to around 50% over a period. If we are able to make the same numbers with a lesser provision, yes, we will be too happy to do that.
And just to clarify, the overall provision that you are carrying on the balance sheet is around in the zip code of 500 crores. I mean, 260 crores are specific provisions against the stage 3 assets, but you have another 540 crores, another 250 odd crores of provisions also sitting against restructured book as well as standard provisioning of for even fresh disbursement side.
Yes. See, we have a total provision of 470 crores. For stage 3 it is 260 crores and the remaining is in stage 1 and 2, including restructured.
Okay. Got it. Thanks.
Thank you. The next question is from the line of Dhaval Gada from DSP Mutual Fund. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. So first question was a data keeping question. If you could give the yield on loans for home loan and home equity for FY22. What's our blended yield in each of the segment, and similarly for salaried and self-employed, including professional, non-professional.
Okay. So the yield is for home loan it is 9.7%. That is salary 9.3 and non-salary 10.2. Average is 9.7. And home equity is 12.8. This is for March 22. And the average for the company as a whole is 10.3.
Thank you. The second question was relating to disbursement. So what kind of disbursement target are you sort of trying to achieve in FY23? And more, 2 year down the line, FY24, what's our aspiration on disbursements, absolute disbursements?
The FY24 we are not so far figure. As far as FY23 is concerned, it will be around 3,000 crores, hopefully.
Okay. And last question was relating to, so what would be our employee attrition for, let's say, full year FY22?
FY22, it was not around 90 people left in the fourth quarter, that's what I know. But just for your information, from 980, the employees have come down to 925.
Okay.
Just for information, we are also planning to recruit so that this is met. The requirement is met.
Okay. And last part of the reduction
have a recruitment in the current quarter.
Understood. And last part of the reduction is attrition. Is it?
Yeah. Okay.
Okay. Got it. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Chintan Shah from ICICI Securities. Please go ahead.
Yeah, thank you for the opportunity. So just one question. So considering 10-11% AUM growth in FY23, so sir, what sort of repayments rate are we looking at? Will that be higher than FY22 or lower than any ballpark number on that?
It should be same. As of now, it should be same. See, our normal repayment is around 75 crores per month. That is around 900 to 1,000 crores. Normal repayment. Okay. The accelerated repayments will be around 800 to 900 crores. And we expect the same to continue or it can come down also. Because of our customers' need and all that, we expect the accelerated repayments to come down.
Okay. And so, sir, on the 17.6% rate which we quoted, a repayment ratio for FY22, so can we have a breakup between balance transfer and the regular repayments?
FY22, you want FY22?
Yes, sir. Yes. Yeah.
FY22 Q4, 466 crores was the balance transfer. We had a total repayment of 601 crores.
Okay.
Out of which 466 crores was accelerated repayment. Other three quarters were 140, 210, 284. And the Q4 was really exceptional.
Acha, Q4 was exceptional. And for Q4 it was 466 crores. And for the remaining quarters, it would be?
That's what I said. Now, first quarter 140 crores, second quarter 210 crores, third quarter 285 crores, and the last quarter 466 crores. This is prepayment. There is any payments made other than the normal repayment.
Okay, prepayment. So this would include the balance transfer as well as the regular prepayments. Means apart from balance transfer, prepayments will also be included here, right? From own funds.
Normal prepayment. Only balance transfer. See, the customer is having extra money, he repay. That also has to prepayment.
Understood. Got it. Sure, sir. Thank you.
Thank you. Participants, to ask a question, you may press star and 1. The next question is from the line of Rajiv Mehta from Yes Securities. Please go ahead.
Yeah, sir, I had a couple of questions. So, sir, firstly, on margins, right? So, where you give some perspective on margins with regard to what the rate reduction that you would want to offer to rein the BT out. But from your interest rate movement perspective, if one were to understand how the margins can move, so then what is the percentage of loan assets which is fixed and floating? And then what is the frequency of repricing of the floating book? And then on the liability side, we have certain bank borrowings and NHB borrowings. Then what will be the floating proportion out there?
Okay. See, we don't have any fixed lending. There is one point. Almost all of our assets are floating. And we will be passing on, if at all there is any increase in the cost of our borrowing, more or less we will be passing on the same borrowing because the market is also passing on. You will understand that already the banks have started increasing their MCLR and so we will also be passing on, but we will be maintaining the margin, that is for sure. But as far as the liability side is concerned, how much is fixed in there? Almost at least 70 to 75% is MCLR based. They are mostly just for MCLR. And that's why I heard that at least 50 to 60% of these 70% is annual basis. As far as our asset side is concerned, reset for annual, right? 6 months. Reset for 6 months. 6 months.
Okay. So the loans reprice every 6 months.
Yeah. Our loans are repriced every 6 months.
And our MLR is reviewed every monthly or every quarterly?
Every month.
Every month. Okay. And those bank borrowings are, so you said majority MCLR, the rest will be EBLR or Repo, right?
Yes.
And out of MCLR, what will be linkage to 3-month MCLR?
I don't have the numbers immediately. I'll be able to give you. Okay.
Okay.
I don't have immediately.
What was the write-off for the full year FY22, sir? I know that there was no write-off in fourth quarter, but full year FY22, what was the size of write-off?
I'll give you. Before the conference is over, I'll give you. It's not much.
Okay.
It's not much. I'll tell you.
Correct. Sir, my question is now on asset quality. Now that with daily stamping coming in, it increases the flow of slippages. With daily stamping coming in, it increases the flow of slippages every quarter. So either otherwise we need to align customer to this new system and educate them to pay on time on the due date. So how much of effort has gone there in terms of bringing customers on board on daily stamping? And secondly, from collection side, I think you spoke about putting up a collection team for early buckets. So what is the plan to increase collections in the pre-NPL buckets?
I told you, as far as the collection bucket is concerned, we try to recruit exclusively for collection from 40-50 people. Already we have issued advertisement for normal recruitment. In that we plan to have an exclusive collection team only for attacking the early buckets. The bucket 1, bucket 2 issue, only for that we plan to have a collection team. to be monitored from our head office. So this is just to bring down the likely slippages in the future quarter. This one. What was your second question? First question, rather?
No, in terms of customer alignment with the daily stamping or...
That is the most difficult part because people are used to paying on the last day, paying only the critical amount and all that. I understand this is a difficult part. So we have been telling our branches that if they meet the customers, they will also be able to impart on them the requirement to pay more than one installment. Whenever that is overdue. I tell you it is getting results. Maybe the customer is not paying 2 installments to be sorry, one he was paying earlier, but at least he is paying something more than one installment. Let us say 10,000 if it's EMI, always he is paying 11,000, 12,000 and all. So slowly things are improving.
Okay. And sir, this restructured portfolio of 670 crore is starting billing from second quarter, you said, right?
Yeah.
Okay. So the moratorium offer was roughly 1 year to most customers.
Yes, 1 year.
Yeah.
आपण ज्या व्यक्तीसोबत बोलत आहात त्या व्यक्तीने
Hello? Hello?
This is the operator.
line.
Yeah. Hello?
One moment, sir. Mr. Mehta,
What is the current origination mix for us in terms of branch sourcing, loan camps, and whether can we add more channels or can we activate more channels so that we get more business from same time?
Yeah. Already we have DSA channel of around 20%. Hello?
Yeah, hello?
Yeah. Am I audible?
Yes, sir.
Yeah. See, already we have a DSA channel of 20%. We would like to maintain around 20-25% as far as DSA is concerned because we already have enough of brick and mortar system in this company. We will be increasing our numbers, branch numbers, by around 10%. As of now, we have 155 branches as of March. So maybe another 15 branches we may open during the year.
Okay. And you said DSA contribution is around 15%, which can be taken up to about 20-25%, right?
Yes. Yeah.
Okay. Yeah. Thank you, sir. Thank you for answering all my questions.
Thanks.
Thank you. Participants, to ask a question, you may press star and 1. Is there no further questions from the participants? I now hand the conference over to the management for closing comments.
Thank you very much. And I will just thank the people who have come participated in the conference with all these issues. I would like to assure the investors as well as the analysts that the company is on the right path. The new management has taken, and the entire team of Repco Home Finance are all enthusiastic. They are doing their best. Definitely, I'm sure that 2023 will be one of the key years, and 24-25 onwards, we will be back to where we were, let us say, 5 years back. And once again, thank you all, including the moderator and executives.
Thank you. Ladies and gentlemen, on behalf of Yes Securities, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.